Hi everybody, it's Paul Brown here from Wealth21. Hope you're all doing well. Put together a market updated recorded on 3rd of September 2023. Firstly and importantly, anything in this short video is just general information only. It doesn't cover your specific circumstances, so if you need advice on your own circumstances, please give us a call or seek advice from an authorised financial advisor. Firstly, let's just have a look at the index returns. Now, these are figures to the 31st of July 23. I don't have the end of August figures yet. So we got the various different sectors and the returns over short time periods and long time periods. Short term, still got a lot of volatility. The bond market's still showing negative returns over the past 12 months as to 31st of July 2023 with a rapid increase in bond rates. And we've still had negative returns in the property sectors. Share market returns were positive in that particular year, though. The interesting thing is the Australian dollar has been weakening. It's weakened 4% over that 12-month period, and actually 2.9% per annum over the past 10 years. So the Australian dollar has been weakening. Over the longer term, over 10 years, you can see that you kind of get the results you expect. Cash and bonds have lower returns. The better long-term returns are coming from property, infrastructure, and shares. Let's just look at some index returns on 3 different risk profiles from conservative, balanced, and growth. Again, over the past 12 months, we actually have had positive returns for all of the different risk profiles. But inflation over that period of time has been 6%. Cash rates have increased. Conservative return for index return was 3.4%, which is well below inflation. Over the longer term, over 10 years, though, you can see that, again, you get the sorts of results you would expect. Conservative 4.8% per annum over 10 years, balance 6.4%, and growth 7.8%. So that's well above inflation, which was only 2.7% per annum averaged over 10 years. And the cash rate obviously has been pretty low over the past 10 years as well. So, these profiles do deliver real returns over the longer term. Short term, though, with rising inflation, it's been very hard to actually keep up with inflation. Let's just turn now to interest rates. So this is a 10-year chart of interest rates in Australia, and you can see that interest rates got virtually down to zero, or I think it was 0.25% or 0.1% in 2021. And then when inflation emerged, the Reserve Bank in Australia increased interest rates pretty aggressively, up to 4.1% per annum, 4.1%, which is where we are now. And that's certainly the highest level we've been to over the past decade. I think you've got to go back to 2012 or even before the GFC for interest rates higher than what we have at the moment. Let's look at the 10-year bond yield. So again, with interest rates being very low, the yield on 10-year bonds was quite low, 2020, 2021. And then the bond yield increased very, very significantly through 2022, and that led to capital losses on bond investments because of bond yields rise. Then the value of bonds decreases, and we're still up above 4% at the moment for the 10-year bond yield. That also reflects, you're getting good returns on term deposits at the moment, but the bond yield, the 10-year Australian 10-year bond rate, or what's commonly known as the risk-free rate, so the return you get by investing, by borrowing, by the government borrowing over 10 years. Okay, so that's what's called a risk-free rate, and it's above 4%. So the return on bonds in terms of income is attractive as it's been since, you've got to go back to 2014 for bond rates like that. Let's look quickly at the Australian share market. This is another 10-year chart, and obviously you see that big fall due to COVID. 37% fall over 21 days, and then you saw a big recovery. through to about August 2021, and then it's been quite volatile, quite up and down over that period of time, and certainly at this particular point in time we're nowhere near the market high, which is around 7,600. And looking quickly at the AREITs, or the listed property sector, so this includes office blocks, shopping centres, industrial sheds and so on. Again, this particular market fell very significantly with COVID when everyone was working at home, and then there was a big recovery, and then it's fallen away. Still some uncertainty. Rising interest rates are not positive for listed property sector. So still down, way down below the high of the market, towards the end of 2021. Looking at international shares, so this is like it's a Vanguard ETF actually, which is a broad international ETF, and you can see that it fell in 2020, had a very strong rise. I mean, this is sort of dominated by the US and Europe, I guess, but you can see that the international markets are a pretty high level at the moment. So there we have it, just a quick update on the various different sectors. If you've got any questions about the investment markets, please feel free to give us a call. Thanks for listening.